VAT, also known as value added tax, is pretty much what it says on the tin. It's a value of money that is added onto an item or a service that is sold in the European Union and the UK. Some people think it's a worldwide tax, but no, it's only used by countries within the EU plus the UK. It's important to note, particularly if you're doing your own accounts, that VAT is implemented as a destination-based tax, which means the tax rate is based on the location of your customer and applied to the sales price, not on the location of the producer. It's also important to note that each country has different VAT rates. So the ones I mentioned at the start of the video, for example, standard rate VAT being 20%, that is specific to the UK. You can actually find all of the different rates by Googling the ones you want. If you've seen the VAT returns for products you're selling across the EU, maybe you're signed up to Amazon's FBA service, for instance, you'll notice that there's different rates applied according to which country the item was delivered to. Another thing to note is that the VAT calculation period, so your VAT period, also varies from country to country within the EU. These are subject to change, but at the moment it's done quarterly in the UK and Spain and on a monthly basis in most other countries within the EU. This essentially means that there's a hell of a lot of paperwork to be done, and hence I would always not advise doing your own tax returns, particularly if you're running a business which is VAT registered or going to be VAT registered. I can guarantee that doing your own taxes will become a full-time job. And if you don't have the necessary accounting experience, you'll also have no time to spend on your business and likely make mistakes which can end up with fines. So either find yourself an accountant by asking friends or family for recommendations, and failing that, I'll add a link to an accounting software that you can use as a pinned comment in the comment section below. So how does standard rate VAT work? VAT registered businesses are liable for collecting VAT on their taxable sales, which then needs to be paid to the relevant tax authorities during the next VAT period. VAT registered businesses are also liable for paying VAT on any of the relevant purchases they make within the EU. And although you won't pay VAT on goods and services being imported from countries outside of the EU, you will still pay import VAT once they've been imported into the EU. So if you're thinking that you can avoid paying VAT by buying products from countries outside of the EU, then you're wrong. Customs will slap on a nice extra 20% if it's a standard rated item when the items arrive in the EU or the UK, and send you a bill for it, and sometimes withholding the products until you pay for that bill. This means there'll be tons of paperwork if you're VAT registered in multiple countries, and hence I would always advise getting an accountant to do your VAT calculations. If you try doing your own VAT submissions for multiple countries, then you're likely to spend most of your time doing an accountant's job as opposed to running your own business. For VAT in the UK, you'll need to register to Making Tax Digital if your taxable turnover exceeds the VAT threshold, regardless of the scheme you want to join. It's a government initiative which has been created to replace traditional VAT returns, and luckily for you, it makes it a lot easier to submit VAT returns yourself. Making Tax Digital requires VAT registered businesses with taxable turnover above the VAT registration threshold to keep records in digital format and file their VAT returns using software which is capable of keeping and maintaining the records specified in the regulations. It should also be able to communicate with HMRC digitally through APIs. If you're wondering which software you can use, and don't worry, as I'll be providing a link to a user-friendly software with great customer service and can easily be linked to HMRC in both the video's description and the pinned comments in the comment section below. Instead of transferring collected VAT to HMRC every time a transaction takes place, companies submit a VAT return indicating the total they've collected and the total they've paid out within the tax quarter. Currently in the UK, VAT returns are submitted quarterly, so every 3 months. In other words, when submitting your VAT return, if you've sold £100,000 worth of standard rated items, which are charged at 20% VAT, and bought £30,000 worth of standard rated items, then you'll be paying 20% times £100,000, which is £20,000, minus the £30,000 times 20%, which is £6,000. So you'll have a total VAT bill of £14,000 in that period. Remember that in most cases, VAT is passed on to the customer. So you might have noticed by looking at your receipts as a customer in the UK or the EU that you're usually charged two amounts: an amount for the goods or service you've purchased plus another 20%. That 20% will then be paid to the tax authorities by the business you've purchased your goods or services from. However, it's not always passed on to the customer. Even though it will show like that on the receipt, sometimes it's absorbed by the business selling the items in order to keep competitive pricing. Although this is quite an unusual case for most businesses, it's quite common in e-commerce, and particularly in things like drop shipping or even selling on Amazon. Let's take Amazon as an example. If you're selling something on Amazon, it's likely to be priced in comparison to your competition. For example, you're selling a pair of socks and all the socks on Amazon are priced around £5. Then you'd probably also set yours to that price, even though you know that someone can buy a pair of socks in Primark for £2. So if you then register for VAT and hike your price up by 20%, you're now quite a bit over the average price, and most online shoppers actually prioritize price over reviews. If you are selling on Amazon or any other platform which prioritizes product ranking by sales volume and price, then this would actually also start causing a whole load of other issues on those platforms, such as rankings and stuff like that, but we won't get into that now. So if that is your situation, then in order to keep your business operating, you can actually absorb the 20% VAT, assuming that you're selling standard rated products. If you're thinking about doing this, then just make sure to do the right calculations. And I say that because if you're selling products which have quite a small margin, then absorbing 20% VAT out of your current sales price could end up causing you to pay more VAT than you're making in profit and end up making a loss. So you should only be making that sort of decision if you know that you'd still be making a profit. So we've had a look at the different thresholds of the schemes, and now we're going to look at the rates. There are actually a number of different rates within the standard VAT scheme. The standard rate is the most common type of VAT, which is 20%. The reduced rate applies to a number of items such as building services, art imports and more, and their VAT rate currently stands at 5%. The third rate is zero rate, which most foods and baby clothes fall into, and that's 0%. And finally, VAT exempt, such as charities and burial services. I'm sure the first question you're asking is, what is the difference between a product which is zero rated and a product which is exempt from VAT? There's a simple answer to this. Products which are exempt from VAT are not charged VAT on their sales, nor can you claim back any credit for the VAT you paid on inputs to produce it. Whereas for zero rated items, you don't pay VAT when you sell the items, but you can still claim back tax credits on your inputs. When I first heard about zero rated VAT, I thought surely there's no VAT to claim back if the item is zero rated and you haven't paid any VAT to purchase the products. So you might be thinking the same thing. Just to clarify that, when you're claiming back VAT on zero rated items, you'll be able to claim back the VAT on all your purchases and costs associated with that product or service, such as bills, materials, and so on. For example, your business sells baby clothes. You spend £500 plus VAT on a reel of cotton to sew 50 baby jumpers, which you sold for £20 each in a given VAT period. You'll be able to claim back the £100 of input VAT from the cotton reel you paid for, and you'll have no output VAT on the £1,000 worth of sales. So instead of paying for VAT for that period, you'll actually get a tax rebate of £100. You made £1,000 worth of sales, you don't pay VAT on them, you bought £500 worth of cotton reel, you paid £100 VAT, but because you're selling zero rated items, you can claim that £100 back. The rate of VAT you pay when on the standard VAT scheme is dependent on the product or service you sell, not the type of business you own as you would do on the flat rate scheme. If your business specialises in selling a product which is exempt from VAT, it doesn't mean everything your business sells will be exempt from VAT. For example, you have a business which sells baby clothes and baby toys. You'd be exempt from VAT on all the sales you make on baby clothes, but you pay VAT on the sales you make on baby toys, even if you've sold £1 million worth of baby clothes at 0% and £1 worth of toys at 20%. You'd still pay the 20p on the pound of toys you sold. Let's look at what's included in your standard VAT turnover. Don't get confused with being on the standard VAT scheme and paying the standard rate of 20% on sales. If you have a business which sells a variety of items, for example, an e-commerce business, and you're on the standard VAT scheme, you can and should itemise your sales. For example, you might sell £60,000 worth of standard rated items and £40,000 of zero rated items, meaning you would only owe HMRC 20% of the items sold worth 60k and nothing on the items, on the zero rated items, which were 40k's worth of sales. So in other words, the amount of VAT you pay depends on each individual item you sell as opposed to the business you run, unless you're on the flat rate scheme. So let's have a look at the flat rate scheme. As a heads up guys, I'm going to make a completely separate detailed video on how to calculate VAT, simply because I don't want this video to drag on for too long. And also I'm going to create a VAT calculator to simplify things for you guys a little bit. So keep a lookout on my channel, and if you haven't done so already, make sure you subscribe to the channel to get a notification when that video's out, and also to stay up to date with my latest videos, tips and tricks. I'll also use this opportunity to say, if you're enjoying the video, finding it helpful, then like and share it. But most importantly, if you have any questions, just drop them in the comment section below and I'll get answering as soon as I can. So we're getting towards the end of the video, and now we're ready to talk about selling abroad and distance selling thresholds. If you're not selling abroad at the moment, then feel free to skip this part of the video, but I would personally suggest watching it because you never know how your business is going to develop. Distance selling thresholds are thresholds which, once are exceeded, mean you have to become VAT registered in the country where you've exceeded that particular threshold. And when we're speaking about distance selling thresholds, or DSTs, it will help to know that the departure country is the country which a product is shipped from, and the arrival country is the country where the product was shipped to. Whether or not you've exceeded the distance selling threshold in any country, you have to register for VAT in countries you're storing goods in across the EU. And just to clarify, that's whether or not you've exceeded any DSTs. Each country will have set their own threshold, so they're not all the same for every country. Distance selling threshold, also known as DST, is calculated based on the total sales arriving in a particular EU country from another EU country. For example, the Italian DST is €35,000. That means if sales that have been departed from either Germany, France, Italy, Spain, or any other EU country and have arrived in Italy exceed €35,000 worth of value in any calendar year, past 12 months, then it's been breached. You will have to tax on arrival for Italy. So the UK will no longer count towards DST due to Brexit, and sales from the UK into the EU will be treated like any other country which isn't in the EU. So you won't need to charge the customer VAT on your sales, but either you or the customer will need to pay import VAT to the country which your item is being imported into. Who pays for the import VAT is dependent on who the importer of record is, and that can be determined by contacting the delivery service used to ship the product. So for instance, you've used Royal Mail to ship your product to a customer in Spain. You'll call up Royal Mail, you ask them who is the importer of record. If they say it's you, the seller, then you will need to pay the import VAT before that product can be released from customs and sent to the customer in Spain. And vice versa, if they say that the customer is the importer of record, then they will need to pay the import VAT before it's released and again shipped to them. If you have exceeded the DST in any country within the EU, then you need to register to become VAT registered in that country, and you'll be paying VAT in the country where the customer is in other words, the arrival country where the item was sent to. If you haven't exceeded the distance selling threshold in a specific country, then you usually pay VAT in the country the item was sent from, in other words, the departure country. And as I said, the UK isn't part of DST anymore, so this only applies to any EU businesses which aren't set up in the UK. So if you're selling from Spain into Italy, who has a DST of €35,000, but your revenue for the past 12 months have only hit €30,000, you will still be paying VAT in Spain because you haven't exceeded the Italian DST. If you're selling goods to customers in the UK which are stored in a country in the EU, then we need to take into consideration something called the consignment value. And that's a new thing that's been implemented since Brexit. Now, if the value of your shipment is worth less than £135, then the seller must collect VAT at the point of sale and pay to HMRC. At the point of sale means as soon as you sell it, you charge the customer the VAT and then pay to HMRC in your VAT returns. If, however, the value of the goods sold are worth over £135, then no VAT is collected at point of sale, but the seller will need to pay import VAT. And that's a seller that's outside of the UK shipping products into the UK. As a heads up, if you're selling on online platforms such as Amazon, then it's a new requirement that the online platform collects the VAT and pays HMRC. So you'll notice that the VAT is already deducted from what the online platform has sent you. And this is bittersweet for some sellers. It makes accounting a little easier. It's closed the loophole where Amazon sellers outside the EU were getting away with not paying VAT to HMRC and hence could afford to reduce their product prices and undercut sellers who had to pay VAT. So it's pretty sweet for sellers in the UK, because you would have noticed a lot of prices actually went up after Brexit, and that's because that loophole was shut. So now we're going to speak about voluntary VAT registration and how to decide if this is right for you. So those who are under the threshold of £85,000 may decide to still voluntarily register for VAT for standard rate VAT. For smaller businesses, this can bring legitimacy to your company, increase trust from shareholders, and enhance the likelihood of future investors. However, it's important to remember that if you're a very small business, these benefits may be outweighed by the added hours spent doing paperwork for HMRC and the added price you'll have on your goods and services. One of the main advantages of voluntarily registering for VAT is that your business will be able to reclaim the VAT on purchases made by your business. So to work out whether you'll be able to benefit by registering before you reach £85,000 threshold, then you should just do some calculations to figure this out, as we discussed quite a few times previously in the video. I'm sure there's a few scenarios where voluntary VAT registration could be beneficial, but I would personally avoid it except for these 4 scenarios. So the first one is, if the majority of your revenue is coming from Xero rated items where you don't pay output VAT on your sales but can still claim tax credits for the value added tax paid on inputs. That's the first one. So the second one is, if you know you're going to spend more money than you're going to make, which usually happens with startups for the first few years. So maybe you're developing a software knowing it's going to take 3 years to develop before you can generate any revenue from your product, in which case you wouldn't have any output VAT to pay, but can still claim back VAT on supplies such as VAT registered freelancers, computer equipment, office space, and so on. Thirdly, this is where you're desperate to give off the impression that you're a bigger company. I want to highlight the word desperate because this will come at financial loss. In some cases, suppliers might turn down your business if you're not VAT registered, and hence you might have to voluntarily register for VAT in order to gain their business. Even in this case, I would just move on and try and find another supplier and avoid voluntary VAT registration unless I really can't find another way of going around it. Fourthly is where your business is mainly dealing with B2B sales, so business to business sales, and your customers, which are other businesses, will likely be VAT registered businesses, meaning you can increase your prices by more than 20%, knowing that your customers will be able to claim back the 20% of their purchases from you because they're also VAT registered. Being registered on the Standard VAT scheme will increase the prices of your goods and services. If you're a small company, this might push away and price out your current client base and lose future ones too. Secondly, if you end up owing the HMRC money because your VAT input was less than your output, this may be a surprising and inconvenient amount. It can be quite hard to prepare for and to budget for, but if you have a decent accountant, then they should be able to advise you on this. Thirdly, another potential negative of being part of the Standard VAT scheme is increased paperwork, whether or not you're doing the VAT returns yourself. This would require more hours spent on keeping your books and, depending on your workforce, potentially more money spent on someone to do that for you. The pros of the Standard VAT scheme are, for smaller businesses, being part of the Standard VAT scheme adds a sense of class and stability to your company, making it more likely to be invested in and to settle current investors. Next, being able to give VAT receipts to both customers and other businesses will again cement you in a certain level of legitimacy. Our next pro is if you're a registered business that sells so-called zero-rated services or products. These are goods or services that aren't taxed at all, such as children's clothes, food and car seats, then you'll be eligible for VAT refunds. Next, if you're a VAT registered business that sells zero rated products and services, which are the ones that aren't taxed at all, such as children's food, clothing and car seats, then you'll be eligible for VAT refunds on the costs associated with those products. So essentially, if the majority of your sales come from zero rated goods or services, then I would highly recommend the Standard VAT scheme for you. Another benefit is, as mentioned earlier too, if you're part of the Standard VAT scheme, you're also allowed to reclaim the VAT you've paid on goods and services from other companies. Just as you're charged for it, you can also detract the amount you spend on VAT. So we're done with the summary of the pros. Let's look at a couple of the cons of the Standard VAT scheme. Firstly, additional paperwork. It can easily take up a lot more time and money, and at the end of the day, those are the two most valuable resources in business and potentially in life, full stop, as well as love. Let's not leave that one out. Another con is if you're in an industry where charging your customers VAT will reduce your sales, you might end up losing a lot of business. So they're the two cons. Now let's look at the pros and cons of flat rate VAT. So guys, I hope you enjoyed the video. I know I certainly enjoyed making it. Stay tuned for more videos, and until next time guys, take it easy.